Hello everyone, and welcome to Chapter 4, Episode 2. We are still talking about inventory, and let me review quickly what we talked about in the first video. And let me get my picture out of the way. So in the first video, we discussed what's happening in the inventory account. We talked about the fact that in Chapter 4, we're talking about carrying a product. And when you purchase product that you have available for sale to customers, you're going to put the cost of that into an asset account called inventory. So let's assume you started with some beginning. So I've just got kind of the structure here of the accounts without numbers. So you have a beginning balance in inventory, and then you have purchases. Additional purchases are added to the inventory account. And over here, I've got a little summary, a calculation of what's going on in the inventory account. We started out with beginning inventory. We added our purchases. And together, that gives you the total cost of the goods that are available for sale to customers. When all is said and done, you either still have something, you still either have your inventory on hand, or it's gone out the door. And when it's gone out the door, you take the cost of that product out of the inventory account and put it into cost of goods sold. So in the calculation, we subtract the ending inventory. That gives us cost of goods sold, and then that is subtracted from sales on the income statement to get your gross profit. Of course, the gross profit is the markup. So like if I had a cup of coffee, if this cup cost me $3 and I sold it for $5, my gross profit would be $2. That would be the markup included in that sales price. We also talked about the fact that when you sell a product, there are two things that you need to record. You need to record the sale itself, credit sales and debit cash, or debit accounts receivable if the customer still owes you the money. And then you also have to record the fact that you no longer have that inventory. And so you would credit inventory and debit cost of goods sold, and that's what I'm representing here when we post it to the ledger. Let's look at a quick example of that. Suppose Acme Company ended year 4 with $85,000. So we're starting year 5 with a beginning inventory of $85,000. During the year, we purchased $500,000 of inventory. That gave us a total goods available of $585, beginning inventory plus purchases. When all is said and done, that inventory is either still here or it's somewhere else. We can look on the shelf and we can see what's still here. We can add that up. So if our ending inventory is 60, subtract that, and we can determine that the cost of the goods that went out the door, the cost of goods sold, is $525. And that $525 would be subtracted from our sales. That was $650. That gives us a gross profit of $125. We also talked about the fact that your gross profit percentage is would be calculated as your gross profit divided by sales. In this case, that's 19%. And another way to look at it is your cost of goods sold would be 81% of sales. The two together, of course, has to add up to 100% of sales. Okay, so that's the big picture. That's the flow of inventory into the inventory account. The cost of product goes into the inventory account. It sits there as long as we have the product, but when we sell it, the cost of that item is taken out of inventory and goes to cost of goods sold. So let me give you a little problem that we will have to deal with. You know, when we first started talking about this, we looked at a shoe store and we bought 5 pair of shoes, and every pair cost the same, $20. Well, what if you're buying a product, and suppose we have, I've got represented here with circles. That's what we do. We buy and sell circles. And in every circle is a number, and that represents how much that circle cost us. So we started out with 2 units costing $4 a piece. And then we bought, in purchase number 1, we bought 5 more units that cost $5 a piece. And then in purchase number 2, we bought 3 more items that cost $6 a piece. So if you look at what's in our inventory account, we started with 8. That would be those 2 $4 items. And then we bought $25 worth. That's the 5 $5 items. And then 18, that's the 3 $6 items. Suppose we sold, suppose we sold 6 items for $10 a piece. So we're making a profit because the $10 sales price is above all these costs. But how much profit did we make on those 6 that we sold? Well, it kind of depends on which ones we sold. Well, so we had to figure out how to deal with that. If we are, say, a car dealership, and we are buying and selling cars, now each one of those cars is very expensive, and each car might be slightly different from the other one. Even if they're all the same model, they've got different options and features on them. So when we sell a car, we want to know exactly which car the customer is buying and how much that car cost us. But suppose, think about Walmart, and when you go over there and you need to buy some new toothpaste. So if you go to the toothpaste aisle, you're going to find a stack of tubes of Crest toothpaste. Now, did all of those tubes cost Walmart exactly the same? Well, it just kind of depends. Over time, costs kind of go up. And so it just kind of depends on what truck they came in on. Well, do they care which one of those you take? If they did, they could watch and make sure you take the right one. But you got to pay somebody to do that. And they would not be that interested in exactly which tube of Crest toothpaste you took. They're all kind of the same. And anyway, you think about all the different multitudes of product that stores have, and they're constantly filling the shelves. And of course, if you're selling milk, you try to push the oldest to the front so the customers will take that. But when you're talking about these durable goods that are constantly flowing in and out, it would be difficult to make sure you knew exactly which one the customer took, and you really don't care. So in accounting, we have what we call a cost flow assumption. We make an assumption about what order the items are coming and going. And that makes it easier to account for things. And again, we don't really care exactly which item the customer took. So one of these cost flow assumptions is the first in, first out method. We call it the Fifo method, first in, first out. If we sold 6, the Fifo method would assume that the 6 we sold would be the first 6. First ones in were these items in beginning inventory. So those would be sold first. There's 2. That means since we sold 6 total, we sold 4 of these $5 items. So we assume, like I said, a first in, first out. So according to that assumption, what was the cost of the 6 items that we sold? Well, these 2 cost 4 a piece, that's 8. And then we had 4 at $5, that's 20. So that's a total of $28. So when we're making our journal entry, we would credit inventory for 28 and debit cost of goods sold for 28. So that would leave in inventory the beginning inventory plus those two purchases minus what went out the door. So that would leave 23 in there. So that is the first in, first out method. Let's talk a little bit more about the specific journal entries and accounting for that. So I've got this same information summarized right here. We had beginning inventory, 2 items that cost $4 a piece. That's 8. And we bought 5 more at $5 a piece. That's $25. 3 more at $6 a piece. That's 18. In total, we had 10 items of inventory costing a total of $51. And then we sold 6 of them at $10 a piece. In the journal, we started with the 2 $4 items. We started with $8 in inventory. Purchase number 1, we debited inventory for 25. Purchase number 2, we debited inventory for 18. Here's the journal. Here's the ledger down here. Then we sold 6 at $10 a piece. Well, first of all, we would have to record. Remember, there's 2 entries to record when you sell product. You got to record the sale, how much you sold it to customers for. In this case, $60. And then you also have to record the cost of that sale, cost of goods sold. We had already calculated that to be $28. Well, if you had it laid out in this other order, first in, first out, I'm just summarizing it here. We sold the 2 $4 items first, and then 4 of the $5 items. That added up to a total of 28. Another thing I could ask, like on an exam, or that you would want to know, is since we had 10 items total, we sold 6, that means we still have 4 in inventory. Well, which 4 do you have? Well, it'd be the most recent 4 that we purchased. First in, first out would leave the most recent items in our inventory. So if we went to the most recent, that would be those 3. We still have those 3 $6 items, and then 1 of the $5 items. So the ending inventory adds up to 23. And since our total cost of goods available was 51, then the ending inventory and the cost of goods sold together would need to be 51. And you might be thinking, okay, would those 2 always add up to equal the total? Well, not if we were missing some or something had been stolen, but for right now, let's just pretend that didn't happen. We will talk about inventory shrink more in a later time. Okay, so if you're buying a large quantity of items, they're small dollar items, they're all the same. The only thing that differs is what truck did they come in on and the cost per unit. So think about what order they came in, and then just one method to account for them is the first in, first out. And notice if we do that, the ending inventory is 23, and the gross profit would be 60 minus 28. The gross profit on that would be 32. Okay? We'll come back and talk about that in a little bit. Suppose instead of using the first in, first out method, Another option is to use what's called the last in, first out method, the Lifo method. Same circumstances, but under the, so we had started with 2 $4 items, and then we purchased 5 $5 items, and then 3 $6 items. So here's what's in inventory. We sold 6, but according to this approach, it was the last items in are the first items to go. So that means that we sold these 3 first, and then 3 of these $5 items. So the cost of goods sold, we had these 3 $5 items is 15, these 3 $6 items is 18. So the total cost of goods sold in this case would be 33. So we would take 33 out of inventory. That goes to the cost of goods sold. And that would leave in the inventory account, calculated here, beginning inventory. So let me go this way. Sum of these 3. I'm having trouble. I move it down here so I can, the math doesn't get in the way. Beginning inventory plus those purchases minus the cost of goods sold, so 18. And we can see that's right. We had 2 $5 items and 2 $4 items, so that is 18. So if we go over here and look at the journal entries for that, again, our purchases are already recorded, and then we record our sales of 60, and then in this case, the cost of goods sold, which we already calculated, is 33, but I'll look at it again here. Last in, first out. 3 $6 items were sold first, and then 3 of the $5 items. So that's the 18 and 15 is 33. So that's the number that goes into this journal entry and is taken out of inventory and debited to cost of goods sold. And that leaves these 4 units, those 2 $4 items, and then 2 of the $5 items. So when I'm doing the last in, first out, the cost of goods sold, start at the last and kind of work backwards to the 6 that you sold. The items that we still have in inventory, last in, first out, the ones we still have would be the oldest 4. So I like to just start at the very beginning. I still have those 2, and then 2 of the $5 items. And again, the inventory, ending inventory and cost of goods sold adds up to 51. Now in this time, the gross profit using the Lifo approach is 27, which is the sales minus the cost of goods sold. So again, we'll come back to that here in just a minute. Let me make the point here that these are cost flow assumptions, or another way to think about it is we are pretending this is the order in which the product went out the door, either first in, first out, or last in, first out. We're not saying that's what it actually did. Remember, we don't know what it actually did. All the product is just jumbled up together in a box. Customers are taking some. We don't know which one they took, but we have to account for it somehow, and so we just make an assumption about first in, first out, or last in, first out. There's arguments in favor of both. That's why the rule makers say, hey, pick one and just go with it. In fact, let's look at those arguments for a second. Here I have represented the numbers that we calculated using the Fifo approach. Our ending inventory was 23, and our gross profit was 60 in sales minus 28 of cost of goods sold. It left us a gross profit of 32. Using the Lifo approach, our ending inventory was 18, and our gross profit was 27. Obviously, less gross profit. Well, there are reasons why companies might use Fifo versus Lifo. These are summarized in the chapter. Let me just kind of walk you through it real quickly. And as a result of the arguments in favor of Fifo and Lifo, the end result is, the rule is you got to pick one. You tell everybody which method you're picking, and then you stay with it. It doesn't mean you can't ever change, but if you do change, you got to make sure everybody understands. It's just kind of complicated. But also, since there's arguments in favor of both, there's also a compromise approach, which is called the weighted average method. And we'll look at that here in just a minute. Think about the comparison between Fifo and Lifo. Which method makes our company look better? Well, that's Fifo. If you compare the inventory, it gives us the largest inventory on the balance sheet, and it also gives us the largest gross profit. Now remember, the facts were exactly the same. In both of the previous examples, the Fifo and the Lifo, we bought a total of 10 items, cost them $51, and we sold 6 of them at $10 a piece. We still have 4. The facts are the same. We just picked a different method to account for it. So we're not saying we really are better off with Fifo. We're just saying it makes it look better. On the other hand, which method would save us the most in income taxes? Well, since the Lifo gave us the lower profit, then it would give us the lower income taxes. So sometimes companies would choose Lifo just to save the taxes. The rule makers, well, what we're talking about in here, as we mentioned it way at the beginning of the course, we're talking about putting the financial statements together to give to the investors and creditors and those who are needing to know the financial information about our business. This is not a tax class. Usually the rules for preparing financial statements and doing your tax return overlap and are the same. But sometimes they differ. In this particular case, the IRS has said if you use Lifo for us to lower your taxes, you have to use it for everybody. It's called the Lifo Conformity rule. And for that reason, a lot of companies don't use it, even though it might save them a little bit of taxes. They prefer the Fifo approach. And also, because the Fifo approach is a little more intuitive and it's simpler, the Lifo method can be rather complicated sometimes. And in terms of saving taxes, the Lifo method, we have a relatively low inflation rate, and the differences are not that significant in many cases anyway. So the incentives to use Lifo just are not there like they have been in some time periods. But you might be thinking, okay, so we've talked about why a company would want to use one versus the other. But if you were making the rules, it seems like you would just make everybody use the right method. Which method is correct? Well, there's theoretical arguments in favor of both from that perspective as well. For example, think about the balance sheet. Which method better represents the current replacement cost of our ending inventory. In other words, if we look at inventory, which method puts a number on the balance sheet that best represents the current value, the current cost of what it takes to buy inventory? Well, the FIFO method has the most recent items in the inventory account, so it better represents the current cost of the inventory. On the other hand, which method does a better job of representing the current ability to make a profit? In other words, matches current cost to our current sales price. Well, the Lifo method takes the most recent cost and puts it onto the income statement. So in terms of looking at the difference between our current cost and what we're selling it for, the Lifo method does a better job of representing that current profitability. So you might say it's better for the income statement. So since there's arguments in favor of both, the rule makers say, kind of throw up their hands and just say, well, pick one, just tell everybody which method you're picking. And also there's a compromise approach, which is called the weighted average. We'll look at the calculations in just a minute, but if you'll notice, it puts the inventory value somewhere in between these two, and it also puts the gross profit somewhere in between the two. In other words, it's kind of averaging the differences. So the weighted average method is we calculate the total cost of all of our inventory, goods available for sale, divide by the number of units, and that gives us our weighted average cost per unit, and we would use that to value the items we still have in inventory and also to value those items that we sold. So if our cost per unit is $5.10, the 6 items we sold would be $30.60, and that's what we would put into the cost of goods sold journal entry, and leaving $20.40 as our ending inventory, the weighted average cost per unit times those 4 items we still have. So $20.40 is our ending inventory, $30.60 is our cost of goods sold, and so that's again kind of averages out the results that you would get using FIFO versus Lifo. So on the exam, when you're looking at this, you need to understand how to calculate. Remember, all of these fall into that general calculation, beginning inventory plus purchases. Let me look back at that. Beginning inventory plus purchases gives us our total cost of goods available for sale, minus our ending inventory is cost of goods sold. And then that cost of goods sold subtracted from sales, and that gives us our gross profit. So when you're looking at this on an exam, make sure you're answering the right question. I might ask you, what is the cost of the inventory, ending inventory, using FIFO, first in, first out? Or what is the cost of goods sold using Lifo, last in, first out? Or what is the gross profit using the weighted average method? So make sure you know what the question is and then answer it using the proper method. And there are several homework problems to practice this. See you next time.